Hi, good evening or good afternoon, wherever you are. So it is another Friday, and this is Nikki, also known as Awesome10X or Faces Trader, for your global market updates. So today's title: AI names that continue to pump, plus earnings commentary on quite a lot of retail names. You've got Elf, you've got Abercrombie and Fitch, you've got Ulta Beauty, you've got Gap, you've got Louis Vuitton, and some Kohl's department stores. And we want to actually just discuss a few of them. Hope that you have some few minutes of your time and let's begin. Okay, let's take a look at all of these movements this month, and we'll continue to actually discuss them. Wait up. Okay, so of course, everybody has been talking about NVIDIA, and so we won't actually discuss too much about NVIDIA, except the AI names that will continue to pump in our view based on that. So we're actually seeing Palantir, after great numbers from itself, is still continuing to rise. If you can see the chart of Palantir, it has been benefiting from all of these AI wave, and we're still seeing that the next resistance is hovering around 14, and you still have a lot of support somewhere at about 10.5, 12, even 11. So there's like a lot of round numbers here that are actually going to be supportive of Palantir, at least in the short term. And you can see that volume. So this can actually consolidate or continue to ramp up depending on momentum of AI names. Adobe, we actually like the company. This was, of course, sharing generative AI tools. You've seen them present the Adobe Firefly since March 21, and they actually were featured during the Google conference, and we're seeing actually more and more people buying up Adobe. Adobe has gone from just a few days ago to about from 345 to about 390. Not as explosive, obviously, versus say the big name like Nvidia, but it is also rising in congruence with that theme. And we are actually seeing that there will be more customers who will very much adopt this creative suite, wherein you're using text prompts to actually generate AI. Plus, I think the beautiful thing about Adobe is that you have a lot of trained images from Adobe. So you're not going to have any legality or copyright issues on any AI generated image that you use with Adobe Firefly. The generative AI tools that they have shared, like the generative fill, is going to be available in the second half of the year. And I do expect that this could return back towards about at least 450, and it's not as expensive as, say, for instance, if you're comparing Nvidia or other like chip stocks, versus say, or even like Microsoft compared to Adobe. I understand they're not apples to apples in comparison, but you've got companies that are actually benefiting from this AI wave, and you don't need to actually pay up a huge price premium. In case you're wondering, Adobe is actually trading below 25 times PE. So this one is actually cheaper alternatives for people to consider. And there's actually growth momentum as well from the customer counts and the fact that it's actually a general tailwind for a lot of content creators. So I think that there are, of course, a lot of competition. There's, of course, Canva. There's, of course, competition like Mid Journey, DAL-E from Microsoft. But I don't think that those other suite of products is actually going to deter people from still using, of course, their favorite Adobe Suite, Creative Suite Studio. So we've got really a ton of upside of recurring revenues for Adobe. And after this, we haven't seen the earnings yet, but I think that there's actually more positive feedback just by viewing all of their releases. So a lot of content creators are very much happy to use a lot of generative AI, generative fills, generative edits. Really wonderful work on the set of Adobe. So this one, we continue to have actually a bias on the buy side for Adobe, ADBE. Let's talk about a little bit about retail. So Ulta Beauty reported last night. And the thing about Ulta Beauty is that you have to recognize, number one, long term, this company has a dominant moat. So long term, I don't really expect like Ulta Beauty to crash hard, but there's a likelihood that you can get in at about 400 below. Ulta Beauty recently talked about how organized retail crime was affecting their sales. There was about challenges. They only grew their revenues by 9%, although that is still considered a beat in terms of expectations, the fact that it's moderating, as you can hear from their earnings calls, and I actually checked that any company that used moderate was actually being sold off by the market, understandably because they have been priced in for huge growth, and yet they didn't deliver. I mean, or maybe it's not that they didn't deliver, but they didn't raise guidance, unlike other cosmetic groups, obviously. So I don't think like Ulta Beauty is definitely like a doggone stock, but definitely in the short term, it's obvious that the market's selling off. Pre-markets, I think it's selling off 10% further. So for the month, Ulta Beauty has already fallen from a high of 550s to a low of 480s, and currently I think pre-market is opening for 40. There might be a sense of risk reward to the downside first rather than upside, given that Ulta Beauty is showing what a massive uh, consumer spending moderation is towards all cosmetic products. Take note that Ulta Beauty handles all the segments from mass market to prestige and the masstige, which is the middle market. So I'll show to you some presentation on Ulta Beauty later on. Now for Gap, actually, even if it made a beat, I would have to say that this is more of a short covering squeeze. From this, I'll just read to you a few notes from the Gap beat. Yeah, they did pick up a lot of low hanging fruit in terms of closing stores, cutting costs. That really helped Gap, basic efficiency, etc. But you still have Atleta, Old Navy, and they haven't yet really returned to growth. So very, very difficult still for some of their brands. And you've got major retailers like Target, Best Buy, still witnessing weak demand. Mid-income consumers are still curbing the spending on items such as apparel. So Gap, the reason why it went up, I think in the first place, I think this one pre-market up 16%, but this could get faded away, guys. I'm not sure when it will get faded, but just be careful about these earnings gaps whenever it's more of a relief rally rather than an actual return to growth. So Gap still posted losses, a loss of $18 million, dollars, but this was a turnaround from a loss of $162 million dollars last year. Sales still fell about 6% to $3.28 billion, dollars, roughly in line with what analysts were expecting at about $3.29 billion. Dollars. Gap maintained their annual sales forecast, and they are expecting second quarter sales to fall in the mid to high single digit range. Second quarter sales is expected to decline about 5%, and they're expecting a lot of analysts are still expecting a loss of 16 cents, whereas the company believes that they can have an adjusted profit of 1 centavo. Wait up before I talk more about Abercrombie and Fitch. Let's show you the chart of GPS, GPS or Gap. GPS. You can see that Gap has been in a long-term downtrend versus like the rest of the retailers. You can see that from about $34, it has reached as low as 7. I'd say that even a gap up towards 10 is gonna be it's gonna be a short sell entity, even if you might see a lot of squeezes here for Gap, but I think that this is more of a mean reversion play that still isn't a reversal yet to the business. So this is more of a good earnings, more of a short squeeze play, but not necessarily a quick turnaround. This, however, is something I want us to be more in discussion of, which is Abercrombie and Fitch. Abercrombie and Fitch literally was a very, very strong number, a very strong turnaround. And I understand why everyone is using exclamation points on this type of an earnings move. This stock price move went from 24 to 30, has since gotten some profit taking, yes, but I would argue that there will be buyers, especially on 25, any gap fills here, 27 to 25, with a lot, as long as there's like profit taking within the next few days, as some people are still doubting about the comeback of Abercrombie and Fitch. Now, take note that Abercrombie and Fitch mainly had a big turnaround or a rebranding since 2014 under the under new CEO Fran Horowitz. So this one is a company that had been closing down a lot of stores from about 1,000 stores, about 700 stores. And they did concentrate a lot towards online with the use of Shopify. And I think the beautiful thing about this company is that they have definitely been in the you've got authentic evangelists that aren't really paid for, and it's obvious from social media. You can see the TikTok, Abercrombie and Fitch, from men to women, have really been showcasing their products for free. So you can see that from a social media standpoint, Abercrombie and Fitch really did well. This came from a modern MBA analysis. Apparently, Abercrombie and Fitch from 2018 to 2021 has reached a 20 a nine almost 20x growth in terms of reach, in terms of who they're reaching out, the millennials, the zoomers, etc. And then you've got a social revenue increase of 206%. This just tells you that Abercrombie and Fitch is using online e-commerce very, very well, and that has really translated well into sales. In fact, the hashtag Abercrombie used to date has been about 343 million from authentic people just talking about their actual outfits, hauls, products on TikTok. So this one is actually a very good video, how Abercrombie became cool again. You've got authentic, genuine, non-sponsored endorsements, getting people to really check out, and it actually translated to a 10-year high from a quarter-on-quarter sales. Reading Abercrombie and Fitch is like getting taught on how to basically be a brand manager and how to resurrect a company from what people thought would go bankrupt into actually, hey, this brand is not really dead. So let's just read through a few things in their actual reports. Wait up. Yeah, let me just read through a few things here. You're seeing Abercrombie and Fitch delivered a decade high first quarter net sales led by 14% growth from all the Abercrombie brands. Gross profit rate is also up 570 basis points over Q1 2022, driving operating margin above expectations. Inventory levels now are down 20% year over year from supply chain recovery and return of chase capability. Company increases full year outlook range on sales and operating margin. So let's read Fran Horowitz, CEO, saying, fiscal 2023 is off to a strong start. First quarter net sales, operating margin above expectations. Net sales grew 3% last year. Abercrombie brands grew 14%, the highest first quarter sales in more than a decade. Abercrombie's offerings is resonating meaningfully with our target customers, setting several other sales records this quarter across genders, categories, and geographies. Work continues in the Hollister brand, where we still manage a healthy business from a gross profit rate and inventory perspective, continuing to improve assortment as we prepare for summer and back to school seasons. Both brands were able to deliver year over year AUR growth and lower freight costs, driving 570 basis points of gross profit rate improvement and a first quarter operating profit above expectations. Looking beyond this, cautiously optimistic on consumer demand, ability to react to dynamic macro environment. We manage our inventory lightly, supported by a strong balance sheet, key strategic investments across our stores, delivering both top and bottom line. Actually, I was amazed reading through the numbers from Abercrombie and Fitch that show to you more of the annual reports here. So this was the presentation from the website. Let's go through this. So you can see that Abercrombie and Fitch today is not anymore the brand you knew, wherein you were seeing shirtless tops from men, heavily sexualized. Of course, that's not the Abercrombie and Fitch. They've managed to turn around the brand, catering to millennials, Zoomers, kids all over. And they have separated the brand to their target market. So Abercrombie and Fitch, Abercrombie Kids, Hollister for the teenagers, Gilly Hicks, which is their activewear, lingerie, etc. And then you've got social tourists. So let's take a look at a few of their slides. They're now a global digitally led omni-channel apparel, of course, thanks to Shopify. So you can see how a company can really grow their sales with less store count. They retail to millennials, specific lifestyle needs. And of course, they have rebranded towards a more classic, casual wear, more comfortable. It's not, and of course, they have all sizes, right? So it's not like just small sizes, unlike before. You can see that Abercrombie and Fitch is a brand, and then you've got Hollister for the younger people or the teens. So for kids through millennials. So young millennials are mostly the Abercrombie and Fitch to above to Zoomers. So 2017, they talked about their journey to stabilize their revenue, to transform. 2023 is already in the growth wave with a 2025 target revenue of about $4 billion and an operating margin increase of about 8%, with a long-term aspiration towards about $5 billion revenue a year and a 10% margin operating. So that's actually great to see for an American brand. Sales and profitability history, take note that last few quarters, they have been growing well. They are still hitting those, so they want to actually grow to about 4 billion. So far for this quarter, they hit about $836 million. So they're on track. Operating income has been also doing well. So let's take a look at their plans. Always forward plans. Execute the focused brand growth plan through digital marketing and social selling. Obviously, they're very good at that. Their TikTok is very, very good. Their social selling is doing very well. Accelerate an enterprise-wide digital revolution. Wow them everywhere. Quality products at value for money prices, and know them better. And of course, operate with financial discipline. So it's a focused brand growth. You can see that they have been listening to their customers very well. Their customers wanted active leisure. And so it looks like their active leisure has been eating market share away from, in my view, away from Nike and Lululemon. They actually are doing well in their influencer channels, as you can see. Very strong social commerce, very strong authentic feeds. So very good in terms of their influencer channels. And then, of course, the overall experience, you can see that they have rebranded, they have changed all their stores. Even in the physical stores, it's not dim anymore. It's not packed with those sexualized male topless. If you remember the Abercrombie and Fitch in the past, like 10 years ago, right? Now it's more catered to a wider audience, and they've also been growing US and international. So doing well, actually. Let me just say that reading through Abercrombie and Fitch is actually, I think, a textbook play for brand marketers because the entire industry in retail has been very, very weak. So seeing this strength in a company, this is an outlier. This is a leader to understand from, wherein with the entire industry shifting their spending away from apparel, the fact that this one is actually growing tells us that they're hitting the mark. So of course we saw Uniqlo did well, fast fashion brands did well, and we can see that actually there are still customers who are shopping. Obviously they are. It's just that they're shifting your spending to which brands resonate to them the most. And it seems like Abercrombie and Fitch is a brand that is resonating towards a lot of their customers. So this digital revolution has been very, very good for Abercrombie. Lots of loyal customers. That's why they have that financial targets, and they're actually hitting those targets very well. If not hitting, it's actually even beating. So this quarter, it was really good. 61% gross margin, very strong. All of the numbers are actually ticking to the upside, all to the positive side. Okay, so Hollister brand still needs some work. You can see the Hollister brand is down 7% year on year, but Abercrombie brands is actually doing very well. There is an improvement, and so that's one to actually watch as well. Cash and equivalents. So you can see that the company today has about $447 million. Their inventory is now down 20% from last year, which is now just $448 million. No borrowings in the short term. They've got, however, a $300 million borrowing under ABL facility, as which is I think it's a credit facility as of April 29, 2023. Gross long-term borrowings $300 million outstanding, with a total liquidity of still $758 million. So you can see that in their income statement, this is a huge turnaround. I'll show to you this one. So from a loss, their adjusted operating income in Q1 2022 from a loss of about 14 million. Today it's about a $38 million non-GAAP constant currency basis operating income. So from a loss to a gain, and that's a very, very strong reflection of their fiscal discipline, their financial discipline, their sales execution. So this is actually one of the best earnings to actually see. And you can also say that the company is doing what they can to reward their shareholders by also repurchasing shares. As of 2021 until today, the company has already repurchased approximately 15 million shares for about $500 million. That would be about, and they still have about $232 million remaining for their authorized share repurchase program to reward their shareholders. So let's take a look at their slides here. Yeah. So for those who are interested to look at ANF, yeah, you can see that there is a short-term resistance here at $32. Company today is trading at about $20 billion market cap. Let me show to you that. ANF. So retail is, of course, not going to be a 10x move, but the fact that, this is a company that's being resurrected from the dead. That's how I say that. That's how I see it. So ANF is a very small company, market cap of only $1.5 billion. So far, their sales are expected to be about $4 billion. So that's your expectation. So you're actually buying a company that is less than one price to sales. This is also a company where the income can actually grow to about $100 million. So this is actually very, very cheap if you think about it. So you're probably paying less than 15 times multiple. It depends on whether their targets get hit, but it looks like this company can execute. So this one is actually something to watch. I think this is the only company to watch in your retail space. A lot of supporters, as I said, about 25. And then in terms of resistance, yes, you've got resistances here at about 30s and 40s. So, but a break of 32 can actually see this hit about 40. So something to watch for those who are looking at some retail names to really look as a safe haven in case you want to actually deploy some cash on some overall good numbers or good execution. Let's also discuss what's happening in the luxury space. You can see that the luxury space are actually sliding. You've got Louis Vuitton shares sliding 5%. Investors are stepping back from the luxury sector. And then there's articles coming out. If Louis Vuitton is Europe's Apple, Europe's stock market might have a problem. Obviously, the booming luxury sector has been seeing their high-end retailers tapering down, wiping billions off the valuations from Hermes, the maker of the Birkin handbag, fashion brands like Moncler, Christian Dior. These were all down 5%. Let's show to you the drops here. And let's take a look at the tradable entries for these as well. Okay, let's watch. Show to you the... LVMH. So we're actually seeing that the European market is heavily influenced, obviously, by all these top luxury conglomerates. And what you should understand is that these luxury conglomerates are trading double or triple the premium of the indices in Europe. So a huge drop. This is like their big tech in Europe, which is the luxury conglomerates, the high fashion brands. This is your Louis Vuitton. LVMH actually drops from about 900 area to as low as 828. The problem here is that their earnings are slipping, as well as the fact that the Chinese consumer, which really is a bulk of the sales of Louis Vuitton, looks to actually have a flat recovery. So it's highly possible that Louis Vuitton is going to get affected for any dampening of wealth from Chinese consumers. And so you might see Louis Vuitton actually drop back towards 700 areas or 750. So it's also trading at about 30 times multiple. As I said, it's trading at a premium versus the European averages, which is one of the reasons why Europe could be a little bit in trouble in terms of technicals, right? Because if your big caps like Louis Vuitton is having a hard time, then you're really seeing the shift of consumer spending from luxury elite goods towards a more competitive value play. You can see that the ones that are doing very well, such as Elf and Abercrombie and Fitch, or even Uniqlo, these are all fast retail. These are all relatively mass market goods and cheaper goods. So we are seeing really a shift in spending. Yes, people are spending. Yes, people are still buying clothes and handbags and activewear, but they might not actually pay too much for luxury. So take a look at the charts. Louis Vuitton showing some probable drop. Chanel actually reported some weakness. Let's take a look at Kering as well. So there, massive drops on Kering. So a little bit weaker on those Gucci handbags. Yeah. So a little bit watch out for Europe because they're big. Your big ticket names like high fashion brands are showing weakness, and that bodes a little bit negative towards the entire aspect of Europe. Of course, it's important to also check recently department stores like Kohl's. You can see that Kohl's actually did very well in terms of their earnings. Their earnings were actually a beat. That's why the stock went up. But the thing about Kohl's is that it's mostly growing. The department store is growing mostly because it's introducing quite a lot of the popular beauty shop, which is Sephora. So here, let's just go through some of these articles. Released on May 5, I'm going to read this to you. Sephora shops inside Kohl's continue to be its brightest spot. Its oldest Sephora locations, those opened in 2021, saw comparable beauty sales grow roughly 15% last quarter from a year earlier. That helped raise Kohl's total beauty sales by 150%. Kohl's has already opened more than 600 Sephora shops in their locations, which means that there is now a Sephora in more than half of Kohl's store footprint. It plans to open one in every Kohl's location by the end of 2025. So you're seeing actually that this department store is surviving, not necessarily thriving because of Sephora. So we can see that actually beauty, younger shoppers are really adamant to actually spend on beauty, cosmetics and beauty. We will actually share later Elf Cosmetics as well, which is doing well, still doing well, still hitting all the cylinders in terms of their growth and their guidance. So, but yeah, so you can see that some of the companies are growing, not necessarily because of the entire store doing well, but just a few. So just a reminder for those who are looking at Kohl's, let's show you the chart of Kohl's KSS. It is up, just like Gap, but actually there's still a downtrend to think about. So Kohl's Corporation has gone down from $60 to about $16, from 60 to 16. Yes, it has rallied from 16 towards 20, but I think that any rallies towards 25 will cap this company down. So just be careful about some of these earnings squeezes or short squeezes. Some of them may not be that long-term sustainable, or it just needs more time. More time first to assess. Now, if you want to take a look at the daily, Kohl's actually got dumped from about 18, rally towards 23, and then fell back to 19. Maybe it can still rally towards 22, 23, or even 25. But those are, I think, in my view, still resistance points for Coles Corporation. Okay, last but not the least, let's talk about ELF. Is it here? Yeah, let me also read to you just to conclude. This one is also a good article. Chanel is flagging weaker US sales but sees a pickup in China. Chanel sales, one of the luxury label's top three markets, have slowed to a single digit growth rate over the last 6 months, adding to evidence that the post pandemic spending splurge in the country has tapered off. Clearly, the trend has softened since November. CEO of Chanel, Philippe Blondiau, said of US sales, adding that the US market had enjoyed double digit growth in 2022 without providing a precise figure. The increase of sales with Chinese shoppers in mainland China as they resume traveling is more than enough to compensate the temporary softness in the US. Known for the tweed suits, quilted handbags, number five perfume, the privately held brand behind the world's second biggest, beyond Louis Vuitton, makes 50% of its sales in Asia. So although we cannot actually trade Chanel, the fact that Chanel is flagging some weak US sales tells us that Louis Vuitton and all of these Montclair, Kering, actually the luxury brands, we're seeing actually a pattern that is evident as well from Walmart's numbers, wherein yeah, people actually spend. It's just that they're actually shifting their spending. So it's highly likely that coming from this retail sector report, that number one, the consumers are still there. They are still spending, obviously, but they are just shifting their spending. So the pie is not necessarily getting bigger. You are actually getting market share differences here, wherein the luxury goods are actually being sold off or shifted towards more mass market goods. And that was actually very evident in Ulta Beauty. Let me show to you the Ulta Beauty here. Since we're going to be talking about Ulta and Elf, which are your cosmetic brands, let's show to you Ulta Beauty investor presentation. Yeah, so okay, so for those who aren't in the know, let's just go through again what Ulta Beauty does. Ulta Beauty is the largest specialty beauty retailer in the US, the premier beauty destination for cosmetics, fragrance, skincare products, hair care products, and beauty services. Founded in 1990, it brings together all things beauty and maintains an omni-channel offering, more than 25,000 products from more than 600 well-established and emerging beauty brands across all categories and price points, including Ulta Beauty's own private label. So you can see that they sell everything. They have a one-stop shop, and you can see that their market is very large and fragmented. They have about US beauty products market is hair care, skincare, cosmetics, fragrance, bath, and others. That's $104 billion. Then basically they cater to everyone: groceries, specialty beauty, mass club, department stores, direct selling, hair salon, e-commerce, drugstores, and all. So 65% of consumers believe the beauty category is significantly connected to wellness. So all of their customers, percentage of shoppers, 66% are beauty enthusiasts. And yeah, and then 83% of them beauty product dollars. What is a beauty enthusiast? She lives, loves, and breathes beauty. She sees beauty more than just a routine, and she leans on beauty for self-care, self-expression. Pardon, I didn't wear makeup for this video, so it might actually not make sense that I'm talking about Ulta Beauty or Elf Beauty or even retail stocks. Then again, okay, this is more of me just reading a lot of the reports. That's why I don't have any competitive edge when it comes to fashion or retail stocks. Either way, this is very cool to actually see and analyze. You're seeing that the company Ulta is essentially all the variety of price points. You can see that actually from their earnings call, they were basically talking about how Elf was doing well in their growth, and the companies in the prestige were actually getting a little bit of lower sales. So it's very clear from seeing Ulta's differentiated model that you're actually seeing a shift from prestige to masstige towards mass. Okay, so definitely that is uh, a picture of the American consumer state today, wherein people are going for the value for money. And that was actually also evident in Chili's, the CEO of Eat, Brinkers International. In their earnings call and interview, Chili's also said, CEO of Chili's talked about people going after the half pound burgers for about $17 because that presented a lot of value for money. So we're actually seeing people spend, and they're spending on the casual restaurants still, but they're just really thinking, where is my $20 gonna be most value for money at? No, so when you're actually thinking of retail or restaurants or the industry itself, there is still a selection here that you have to process. There's a reason why there's a premium being paid for Elf, and there's a reason why Ulta is actually falling tonight, or the fact that Coty is also falling. Okay, so there is actually a change in market shares or differentiated models. You can see. Okay, so strategy, all things beauty. I don't think that we need to discuss all of that. Um, but yun, so Ulta Beauty, however, remains to be one of the largest beauty cosmetics brands. So I know that people would sell it off, but I don't think that it will get massively downgraded to the point that you cannot buy the stock. Take note that the dips of Ulta Beauty would end up being a buy. It's currently about 25 billion. I think that you might have a chance to get this at 20 billion, such that you might get this sub 400. So let's see if we can get it below 400. Pre-markets is already trading at pre-market. Ulta Beauty, I believe, is trading at 440. I don't know if it will fall 20% for the day, but it could happen for the next few months. As you can see, other companies are not really trading above 20 times multiple for a company like this. Um, Let me show you the numbers of Ulta. So I think one of the things that the reason why you've got a gap down on Ulta is because there is a slight decline. You can see that the comparable sales is just up 9% year on year for Ulta Beauty. This is some moderation versus past sales increases. You've got that decline, and people were a little bit, I'm not sure if they were disappointed, but the fact that the diluted earnings per share is now hitting about $6.88 per share. Your operating income is just about $600 million here. Sorry, your operating income or your gross profits maintained at about 40%. You've got an increase on your selling and G&A, such that your operating income is now lower from a year-on-year perspective. That's actually affecting the people who are paying for Ulta's growth. So I'll just read to you what the commentary from the CEO himself is. This year is off to a positive start. Operating margin, diluted EPS is just consistent with our internal expectations. It's just in line. Store traffic remained healthy. We are strengthening engagement with the Ulta Beauty brand. We continue to evolve. We remain confident in the resilience of the beauty category and in our ability to drive share. In our ability to drive shares, loyalty program, our world-class team. Nonetheless, you can see there's moderation in those sales. The selling G&A, they talked about a lot of organized crime actually in their earnings call. So I would say that this company, it would take some time before this one goes back to an uptrend, at least from the chart perspective. So this one for Ulta, we will see a decline, at least in the short term. The beautiful companies, for those who are in the buy list, however, are in the mass market brands. So it was actually evident during the Ulta Beauty conference call, and they were hyping up actually Elf, that Elf was actually growing fastest in their brands. So Elf and ANF are actually today mass market companies. They have been doing well. What are the insights that we are reading from these retail reports? What we're seeing is that mass market companies are doing well. Chanel and Louis Vuitton are seeing sales taper off. This is congruent with a lot of the analysis and data that Chinese consumer is actually flatlining. You've gotten those reviews from Estee Lauder. You've gotten that from Alibaba. You've gotten that from Starbucks. So this Chinese recovery is actually going to be slow. You actually have a tradable sell area for Louis Vuitton for those luxury goods. This also means that even the super wealthy people from America to US are shifting a bit to the downward, evidenced by Walmart, Home Depot. Consumer spending is real, but there is a shift. And since China's reopening is weak, the reliance of LVMH from overspending Chinese shoppers is dreamlike, given Louis Vuitton trades 3 times PE multiple, 3 times larger than the average industry in Europe of about 12 times. So this one is actually a very good tweet coming from Chris Camillo, the Money TV. I just want, and of course, some of their listeners as well and their watchers. Obviously, I'm going to read to you. Obviously, NVIDIA is the buzz, but Abercrombie and Fitch was up bigger today, up over 30% today. Chris Camillo called it. Looks like it was there to be found in the TikTok comments, popular videos, and hauls. Take notes, those TikTok videos, 350 million. Apparently, those are authentic feeds that definitely, I think, it just so happens that I'm not really, as I said, I'm not really a fashion or beauty type of a person. But this is a company, Abercrombie and Fitch, that if you were just watching social media and TikTok and comments, you could see that the people who were really sharing their hauls on Abercrombie and Fitch would have already told you or helped you predict that this company would have higher sales compared to the retail industry. You saw that Abercrombie was growing 14%, whereas Hollister brand was down 7%, or the fact that there are industry reports like Gap, which is still down from a sales perspective. The only reason why Gap is up is simply because there were very, very low expectations. Let's show to you the ELF numbers as well for those who are wondering, hey, why is ELF going up to all-time highs, right? So ELF reported just last May 24. Let's take a look again. So ELF has been really blasting off in terms of all the market share. You can see that ELF's biggest quarter, this is one of the biggest quarter of net sales, the 17 consecutive quarters of net sales growth. So you can see that ELF has been going up from 20s to 100s today to all-time highs, defying gravity. Okay, so this has been defying gravity from about the low of about $22 here. Obviously, this drop was just panicking as there was no fundamental reason if you just take a look at the ELF numbers here. So if you take a look at this, although there was some panic, right, in 2022 from a growth of 50%, there was some tapering off. People saw that there was a peak. They were very much surprised on that overall growth. Plus 26, plus 33, plus 49, plus 78. And the share price actually followed suit. So this one, to this one, to this one, to this one. So 4 consecutive quarters of growth plus a very, very low price equals ELF Beauty going 5x. Now, I'm not saying that that is something that we can still assume that will happen again, but it's important to showcase that ELF has been going up with the growth of their earnings and their sales. And this is possibly, in my view, what Abercrombie and Fitch would want to be, right? So in the cosmetic space, Ulta Beauty isn't actually doing well, but the small brands like ELF is doing very, very well. Net sales up 78%, gross margin up 470 basis points, adjusted EBITDA up 66%. You've got ELF Cosmetics growing more than the entire color category. And then you've got top 5 mass cosmetic brands and share. ELF is now 9.5% market share above CoverGirl and Revlon. They know their target market, which is the masses, and they're just behind L'Oreal and Maybelline. ELF, which is now a top 5 mass cosmetic brand, is now up 270 basis points in terms of market share, getting it and taking the lunch from CoverGirl and Revlon. So you're seeing actually this company is a high flyer because of its own execution. Elf Skin category is also up 55% against the entire category. Take note, that is like a smash beat, right? Recognition over the last year. So you've got a different kind of beauty company. Gen Z's favorite Elf Cosmetics becomes an entertainment powerhouse. Okay, so you're seeing that the teen favorite number one brand is Elf, right? So wow, that's a huge teen brand. And then skincare right now is number nine, a brand among teens. Number one is still CeraVe. Number two, The Ordinary, Cetaphil. So Elf is still working on the skincare brand. They're actually going up in terms of market share. In terms of favorite shopping destination, number one is still Ulta. Second is Sephora. So Ulta, that's why I'm saying that Ulta is not gonna go down like downtrend. You will actually have buyers in Ulta. And just like Kohl's is actually doing well with Sephora, you will always have Ulta and Sephora as mainstays, right? You've got a lot of people still buying there. Third would be Target, Walmart, Amazon, CVS, Shane, and then Elf. So amazing. It's now a favorite shopping destination. Okay, executing our five strategic imperatives, build the brand demand, strength across platforms, lots of TikTok billionaires. So just like Abercrombie and Fitch, you could see that Elf has been executing very well on TikTok. It seems like a brand that does very well on TikTok is actually a brand that is really getting viral in terms of sales. So definitely, these are quite a good way to actually check a retail brand. Um, and of course, they made some TV commercials. Number one, Mass Cosmetics SKU. Number one, Elf Cosmetics SKU, the Power Grip Primer. And then they've got, they also mentioned that they can actually take a concept to execution in just 3 weeks. So a lot of impressions. You can see 57 billion impressions, brand sentiments. So they've been doing well in their commercials. They actually had some Chipotle collaborations for makeup palettes, right? Dunkin' palettes, very good. This was 4 billion impressions, 5 billion impressions. So this was American Eagle Outfitters. You can see that ANF and ELF knew their target market very well, right? So in some ways, buying Abercrombie and Fitch is also buying ELF. That's why I'm saying that if you miss the boat on ELF, you may actually still not miss on American ELF. There seems to be quite a lot of synergies happening here with the same target market. Unaided brand awareness, you can see that. So they're both actually being digitally powered very, very well. Digital consumption is greater than 75%. Okay. Number one, Mass Cosmetics, Beauty Squad loyalty programs. Okay, so there's a lot of things that you can learn from reading the ELF and the Abercrombie and Fitch. You can see, all right, Holy Grail. You can see that they're all value for money. ELF, $10 versus a $54 Prestige. $7 versus $31 Prestige, 11 versus 38, 10. So price-wise, they're actually doing well. That's why they have leadership across almost all categories, especially with their consumers wanting value for their money for high quality products, not breaking their wallets, right? Look at that. They are now the number one primer in terms of dollar share, number one in brushes, eyebrow, setting spray, highlight, multi-eye, eyelash curler, eye primer. Wow, that's like wonderful. Almost all the categories, right? Sponges, concealers, eyeshadows, bronzers, lip shine, eyelash. Wow. Okay. So they're building some growing franchises, as you can see. They're very well into the Camo franchise, the Putty, the Halo Glow, the Power Grip. So they've been actually growing it over time. And that's why you can see that ELF is actually one of those cosmetic brands that's actually perhaps being seen as a footstep or following the footsteps of Ulta Beauty. So this is a company that has been growing pretty on fire since 2019. So 2019, this company went from $7 to as high as $32, went to an all-time high, and has been defying gravity ever since, right? So amazing, right? From about $34 to about $100. So of course, a lot of momentum players are in the boat here, riding the trend. But definitely, I think it's not just a trading all-time high story. Definitely, there's fundamentals behind ELF. So congratulations for anyone who was actually number one. If this was your cup of tea, what does the stock market tell you? Number one, what do you learn from all of these earnings reports? What you learn from these earnings reports is that if you have a niche, you're very, very good in fashion retail, and you can see that the social media is clamoring for those products, then there's definitely room for growth when the market is mispricing these brands. Because who would have known you could make like 5x in a beauty and cosmetics company? And although I'm not saying or not predicting that you can make 100% on Abercrombie and Fitch turnaround, maybe you can. Because it's not like trading a 30 times multiple, its price to sales is actually less than one. There's actually still potential room for growth. And there's potential room to exceed Wall Street's expectations. So we learned today that the American consumer and the Chinese consumer is still spending, but they're shifting their spending. So retail is not a goner. You just have to choose and select which retail stocks you're going to have to buy. And if you want to buy it and hold it, then definitely. Obviously, ELF is not a stock that you can predict how high and how low. Clearly, with a company firing on all cylinders, this is a company that you do not sell. Congrats to those who have it. For those who want to short it, maybe you can make about 5%, but I don't think that the trend is your friend when you are shorting a company that's executing well. If you want to short the cosmetic space, it seems more likely that you should be doing it on ULTA, where the market is actually seeing a shift from prestige goods to mass market goods, which means that those revenues will actually falter over time. And so those share prices will also falter over time. So that's it. I hope that you learned something today. And really, reading earnings reports was quite skimming, reading, listening towards earnings calls is helpful to help us decide what to do with stocks. Thank you very much, guys, and hope to see you again next week for another Awesome 10X Free Friday class. Thank you very much. Bye bye.